Okay, we're going to go into deductions. And after we do the deductions, then I think there would be a break coming up. So this is in tab F. Do y'all have any questions about adjustments? Okay. So deductions. There's like the two main deductions, and then we want to focus on the standard deduction. So we finished up our adjustment. So we have our income minus our adjustments, and then we're going to minus these deductions. So as you can see, we're working down to help the tax client reduce their income. So the goal is to see what adjustments or deductions they qualify for to reduce their taxable income. So we have the standard deduction. So this is the allotted IRS amount given based on a filing status. Deductions are subtracted from a taxpayer's adjusted gross income. So income minus adjustments equals AGI, adjusted gross income. Then from adjusted gross income, we're going to subtract the deductions. They reduce the amount of income that is taxed. Most taxpayers have a choice of taking a standard deduction or itemizing their deductions. When taxpayers have a choice, they should choose the type of deduction that results in the lower tax. And right now we're going to see most individuals, they're going to have to take the standard deduction. So there was the Tax Cut and Job Acts that was implemented, and it goes up until 2025 tax year, where it increased the standard deduction. It almost doubled the standard deduction. So it did eliminate a lot of people from being eligible to itemize, and we're going to go just a little bit into itemized deductions. So a standard deduction is for most taxpayers, it's a set dollar amount based on the taxpayer's filing status. An increased standard deduction is available to taxpayers who are 65 or older or blind. There are limitations on the standard deduction for taxpayers who can be claimed as a dependent on someone else's return. Itemized deductions allow taxpayers to reduce their taxable income based on specific personal expenses. If the total itemized deductions are greater than the standard deduction, it will result in a lower taxable income and lower tax. So we have a choice of either taking the standard or itemized. Again, like I said, most of us are going to be taking the standard deduction now just because it, over recent years, the tax law has increased the standard deduction. It doubled the standard deduction. So this is a set given amount for each filing status that the IRS has. This one requires taxpayers to have expenses. You have to have certain expenses that are going to be greater than the standard on there. We're going to highlight just those dollar for dollar expenses to see if it'll give them, put them over the standard deduction. So for the standard deduction, and it increases incrementally each year for inflation. So for a single or married filing separate return, the standard deduction is $12,950. So this is for a single individual who's not claimed as a dependent. Their standard deduction is $12,950. So that's a already set amount that it's given to you. So your income, you made $20,000 for the year. Then you didn't have any adjustments, but you get this standard deduction of the $12,950. So you're only paying tax. Your taxable income is just the difference. You'll see married, filing joint or qualifying survivor spouse with dependent child, which is that qualifying widow, widower. You'll see their standard deduction is $25,900. Head of household, $19,400. So this is reducing their income. So it means what they're paying tax on is going to be a lower amount. Now we talked about those individuals who are dependents or maybe they're 65 or older. They're going to get an even higher standard deduction. So we go to this page. So this is in your F2. So you see if we have somebody that's single and say, for example, if they are 65, we're going to go single and we're going to look at one. So they have one exemption, one additional qualifying. We see their standard deduction is the $14,700. So their standard deduction is even higher. So that means it's going to reduce their income even more. Well, say, for example, that single person is 65 and they're blind. So we're going to go to single and two. Their standard deduction is $16,450. Now, you don't have to worry about what a person's standard deduction is because, again, when they fill out that intake form, that's already been taken care of. When you go into TaxSlayer and you enter in their date of birth, you enter in their filing status, that's already taken care of their basic standard deduction. Then there's also on the intake sheet, it asks if someone is blind. If they're blind, again, we've selected that under the basic information in TaxSlayer. So it is already taking care of this standard deduction for us. It's going to do the filing status. It's going to do if there's any additional qualifying. So if we had a married filing joint, I've actually had this at my site, a married filing joint couple and, a married filing joint couple, and they both were blind on there. So that means they got two exemptions. So their standard deduction was a $28,700 on there. But I didn't have to figure that amount out. TaxSlayer did that for me. So this is just the additional chart that it'll figure out for those individuals. And then also for those individuals who are claimed as a dependent, it's going to take a look at their earned income or unearned income. So if they have earned income, it's going to take their earned income and it's going to add the $400. So pretty much their standard deduction will be up to a single individual, which is at $12,950. If it is unearned income, it's going to be that $1,150 on there. So say, for example, if a single person, a single dependent, if they made $4,000 and they made that $4,000 in wages, it's going to take their earned income, is going to take that $4,000, add additional $400. Their standard deduction will be the $4,400 on there. So it still kind of evens out for those dependents. Definitely when it comes to, again, earned income. So income that they work for. Bless you. So then we talk about these itemized deductions. We may have just a few of them at our site location on here. But again, so we're going to use that single individual. Their standard deduction is already $12,950. And they say that they want to itemize. Their itemized deductions, it has to be greater than the standard deduction. So they need to find some expenses listed on here, and it needs to total more than the $12,950 for me to want to use that deduction on the tax return. The higher the deduction, the less taxes that they're being paid on. So these are some dollar for dollar, certain taxes paid, and it's limited to $10,000 on the return. So real estate taxes, property taxes. So we want to go for those people that are homeowners. And it's typically those new homeowners on there, typically not those individuals that are 65 or older, are probably disabled because they have certain qualifying credits or adjustments on their taxes. Individuals 65 or older, they get a special tax break on paying their taxes. So they're not paying as much property taxes. So you can see real estate taxes or property taxes, then sales tax. So the IRS also allows us for sales tax. We don't want to keep all of our receipts for all the purchases that we make. So they do allow us, based upon your filing status, based upon your gross income threshold, they're going to estimate how much you would have paid in sales tax. Also, they will also allow you to do large purchase items. So if a person also purchased a vehicle, so that means they get the table amount for sales tax plus the sales tax on that large purchase. Then we have state and local income tax, but that's not for Texas. We don't have state and local income tax. So for a Texas resident, we would be looking at our real estate taxes for a homeowner and then the sales tax. So that's where I first lead when someone says they want to itemize. Are you a homeowner? Typically, if they're not a homeowner, they won't be itemizing. Then we have the home mortgage interest and the PMI. So again, for those homeowners, their interest. So we know that housing prices went up. People are typically, when you first get your mortgage, you're paying more in interest than you are in principal. So they receive a Form 1098 from their mortgage company, and we add that mortgage interest, also with those property taxes. We know also property taxes are increasing. So those could help them get over that $12,950 for a single individual. Then also gifts to charity. Anything that is a 501c3, this could also be churches, synagogue, temples, anywhere that a person goes to worship. They're automatically considered 501c3s. They don't have to apply for it. But also 501c3s like American Red Cross, St. Jude, people that give to those gifts to charity, these are dollar for dollar. Again, we would add up all of their amounts to see if it is more than the $12,950. We won't go into the casualty and theft loss. That's a percentage, but it has to be something very significant. Like if there is a tornado, something that damages maybe their home. But again, we also have to factor in their insurance payments. And then there's the certain miscellaneous deductions. So the biggest one is gambling losses to the extent of gambling winnings. So someone enjoys going to the casino. If they say they lost money gambling, well, did we receive a W-2G from them to show their gambling winnings? Because again, it's only losses to the extent of winnings. If we have W-2G forms and say they made $10,000, but they say they lost 12, we can only write off up to the 10 that they won on there. So all of this would want to be greater than the standard deduction listed based upon their filing status and their qualifying. So again, a single person, the $12,950, married, filing joint, or qualifying widow, widower, the surviving spouse, that $25,900, head of household, $19,400. So again, this is why we're going to see a lot of people that are just going to be taking the standard deduction. Okay, and the last one here is our qualified business income deduction. Again, this is automatically calculated for us by TaxSlayer. This is our sole proprietor self-employed individuals. So again, it's for tax years 2017 before, so it's going to end with 2025 tax year. It is for pass-through businesses. So sole proprietors are categorized as pass-through businesses. A sole proprietor that reports a profit on Schedule C will be able to take up to 25% of qualified business QBI as a deduction on the tax return. So they have to have a profit. If they have a loss, they're not getting the qualified business deduction. And it's up to 20%. The calculation on Schedule C and the Schedule SC, that's the self-employment tax, are not affected by the deduction. The taxable income is not reduced below zero by the 20% deduction. And the 20% deduction is limited for higher income. But again, for our VITA program, we wouldn't have to worry about this being limited. But yes, if they have a net profit on there, and it's not going to reduce it below 20%. So for self-employed individuals, they're typically getting another deduction listed on their tax return. Again, this is for tax years 2018 to 2025. And again, TaxSlayer is going to calculate this deduction for us. And this is only for our sole proprietors, our self-employed individuals. So the taxable income that does not exceed the applicable threshold, the qualified business income deduction is the lesser of 20% of qualified business income or 20% of taxable income. So the qualified business income is reduced by the deductible part of the SC tax, the SC health insurance deduction, and by contributions to a qualified retirement plan. The deduction is claimed on Form 1040 and can be taken in addition to the standard deduction or itemized. So you'll see this listed on the tax return. There's a line item that has qualified business income deduction. And again, it is the 20% on there. So for our self-employed sole proprietors. Okay, so going to some poll questions. Roderick is 64 and blind. Can he claim an additional deduction? So don't forget we had those deductions again for the standard deduction, and they have a higher amount if they are 65 or older and blind. So Roderick, he is going to get an additional deduction because he's blind. He hasn't reached the age yet, but he will get one for being blind. So he's going to get a higher standard deduction, more than the $12,950. Leticia died in May just before reaching her 65th birthday. Does she qualify as age 65? Now this one I know we didn't go over. We typically look at a person's age as of December 31st. So she is just going to still get the standard deduction. She's not going to get the additional amount because, again, it'll look at her age as of December 31st.